Hi, my name is Ashley Rosser with Victory Fiduciary Consulting, and welcome to our first edition of Midweek Market and Money Updates. And so we plan on doing this video series every Wednesday as an opportunity for us to kind of share with you what we're seeing within the market, important trends or different decisions that we're making as a result of the market, and what we think might be important updates for you. And so today, I really want to talk to you specifically about what we see regarding the market, volatility, what's driving it. And over the weekend, I was talking with my husband and I was joking that I feel like we're kind of in a third market type that's not been quite identified yet. And so I was joking with him because what we know is that in a bear market, that simply means that the stock market prices are trending down and they appear to be continuing to trend down. And so in these types of instances, typically we may be in a recession, economy is probably slowed, unemployment is probably high, and just in general, economic growth is probably, as I said, slowing or stalling. And so that would be an example of a bear market. A bull market is just the opposite. It's where stock prices are trending upwards, and it is believed that that trend will continue to move upward. And most financial experts will agree that we've probably been in a secular bull market since 2009. And so I was joking with my husband, though, that I feel like we're not in a bear market or a bull market, but rather we're in a kangaroo market. Because right now, all you see is the constant ups and downs. We're jumping up, we're jumping down, we're landing, and we don't even know why we're landing where we are, and then we take back off, and there's no rhyme or reason. And so I joked and said, we're in this kangaroo market, but there might be a little bit of truth regarding why the market that we're in right now seems and feels so different. Because certainly there are some very specific differences from what we would typically see in a normal market. And so I just thought today we might be able to unpack a couple of those details together about how they're impacting stock prices and what's been happening. And so the first thing I want to talk about is just what a volatile year we've experienced so far. We are on pace to have our most volatile year in 70 years. And so when we look at outside trading days, that simply means that a stock either rose greater than 1% or declined more than 1% in one trading day from start to close. And a typical year will have about 24% of trading days be outside days. Currently, we're above 54% of our trading days this year have been outside days. And I mean, that's incredible when you think about that and just the level of volatility that we're experiencing on a daily, weekly basis. We're literally going through entire cycles in a week that sometimes would take us a whole quarter or a year even to go through. So everything's happening exponentially faster. We're seeing these, crazy pickups and then drawdowns. Just last week in 2 days, we drew down 7% in some indexes. And so just the volatility is just, it just remains so elevated. And, along with the volatility, we see an incredible amount of speculation happening in the market also. We're seeing investors who are kind of entering in for the first time, buying individual companies. They're taking 401k loans. They're dumping everything they can into individual stocks. And a lot of the stocks that they're choosing, we will call them high speculation because they're going into bankrupt companies. So companies like Chesapeake Energy, Hertz, where they think that there's opportunity to buy a really inexpensive stock and then be able to sell it a couple days later or a week later and make a significant amount of money. This is kind of what's happening, and we call it pumping and dumping, when people put their money in the market with the expectation just pull it out a couple days later after maybe it's ridden up some. So we're seeing high speculation, we're seeing greed at all-time levels right now, fear of missing out, all-time high levels. And so that's actually a pretty big concern for us when we look at the market. And so this has certainly been a part of this kangaroo market that we're experiencing. Second, when we look at the Buffett indicator, so the Buffett indicator is simply the mean cap value divided by GDP, which gives us a percentage. Anything from 75 to 90% would be considered a neutrally valued stock, fair valued stock. Anything below that would be considered undervalued. Anything above that would be considered overvalued or expensive. And so But over 125%, we enter into this severe overvaluation area. And that's where we find ourselves right now, that we're in this severe overvalued space. The last time we were this overvalued, you can see in the chart, was back in 2000, and you know that the market had a significant meltdown at that point. Along with the Buffett indicator saying that we're overvalued, we know we're overvalued just by looking at PE ratios. And so even though it doesn't seem like it right now, because in this kangaroo market, it seems like the market is jumping up at times for no reason, corporate earnings are tied actually to stock valuation. And so we look at PE ratios, and PE ratios are always tied to the valuations of stocks eventually. Sometimes they do run in a corridor, kind of uncorrelated, but eventually they have to reconcile and kind of come back to running parallel to each other. And so coming into 2020, we were pricing in S&P 500 values at $160 a share. Current valuations where the market is pricing in S&P share value prices of $180. So that's pretty incredible when you think about the fact that that would mean corporate earnings would have had to go up significantly since the start of the year, and we know that that's not the case, certainly for the short run. So that means that there needs to be a reconciliation that happens here. So we've got stock prices going this way, way above where earnings are. And so the only way to reconcile that is for earnings to come up, which again for the short run seems unlikely, or values have to come down. And that we know history tells us that when we get this far disconnected, it always winds up that value comes down to meet where the earnings are. And so this is our 6 indicators here. So we do use 3 long-term indicators, 3 short-term indicators to help us determine should we even be in the market or should we be in a defensive standpoint. And so where we stand right now, 3 of our indicators, the short-term indicators, have turned positive. Then we have 2 long-term indicators that are negative still, and we have 1 long-term at a caution. And so the reason why I say caution is because the dynamic asset level indicator that we look at, when we originally raised cash for our clients, domestic equities had fallen from the 1st to the 4th class. And so it was overtaken by currencies, fixed income, and then cash. Although now domestic equities has moved to the 3rd slot. So it overtook currencies, but fixed income and cash are still ahead of it, and saying that those are the better opportunities for now to be. And so that's why we say caution. The fact that even though it's a somewhat of a favorable response, we're still on that 3rd ranking there. We look at some of the things that have affected these short-term indicators and these rallies that we've seen. The Fed has really done its best to pump as much liquidity into the market as it could. It made some promises about buying, bond ETFs, and even saying that they'll go out and buy individual bonds. And what's funny is that the Fed didn't even actually have to do it because it hasn't spent even really a drop in the bucket of what it said that it would. They just needed to make the statement that they were going to do it, and the market responded. We look at what will have to happen for us to have a V-shaped recovery, which is really what all the bulls have priced in. So the bulls have priced in the fact that we're going to have a vaccine that's going to be effective immediately, even though vaccines typically take years to come into fruition. That it'll be effective, that people will get it. The consumer sentiment will come back to a place where people believe that they can go and spend money on things other than just what they need, that they'll feel more secure. The V-shaped recovery is pricing in the fact that people won't be fearful of going out in public, that they'll go to ball games, that they'll get on an airplane and fly, across the country and be able to start going on vacation and spending money, putting it back into the economy. So it's saying that corporate earnings are going to rebound right away, that GDP, even though next quarter it's slotted to go down to negative 30%, it's just going to bounce right back up, 3rd quarter, that we're not going to have a resurgence of the virus, that we're not going to have any more tensions with China right now. So all of these things, it's pricing in an absolute perfect recovery. It's left no room for disappointment. And so we saw that even last week as that sell-off came, as we began to learn about those increasing cases happening in Texas and Florida, and the market became a little worried about that. And so my concern is that our economic recovery is going to be much slower than what the market is pricing in. I mean, if you listen to Jerome Powell last week on Wednesday, and his discussion that he had with America was actually, it was very somber, where he talked about that this recovery was going to be difficult. He also talked about the fact that he was going to keep interest rates that he foresaw through 2022. So to me, that says that the Fed is admitting that it's going to take quite a bit of time for us to get to a point where they can even consider raising interest rates from where they are now. And it's certainly not just going to be an immediate snapback. I've read a lot of different opinions that say that we'll probably have something more like a Nike swoosh, where we had that initial kind of recovery, and then the rest of it is going to be very gradual, and it's going to take time. We're not going to recover these unemployment numbers overnight. 40% of the people who lost their jobs in April, their jobs have now been taken away permanently. So wrap your head around that if you lost your job in April, 40% of them, they're gone. Those jobs don't even exist anymore. It's going to take us years and years to recover from where we are from an unemployment standpoint, alone. And so that's why, I really think that when we look at how the market, has responded and rallied on hope and all these things, like hope is great, and we do believe that our country is going to absolutely recover and get by this, but it's just not going to happen overnight. We're just now beginning to get some data that we can begin to kind of unpack the damage that was done as a result of COVID. And so it's why that right now we still say we have to take caution. We take these things, seriously, and the fact that we're so overvalued and that the market is so disconnected from reality should certainly be a reason, to give us pause. We definitely believe that math wins. We have a math and a rules-based process, so nothing that we do is emotionally driven. That's really helpful because emotion never gives us the outcome, that we're looking for. And so I think it's important, to have a process and to know that we're going to be looking very specifically. So when we do begin to move back into the market, which we're hoping to do very soon, earnings season is here, and so we're hoping that we can kind of get a feel for how the market's going to respond and kind of embrace these earnings reports as they begin to come in. We're going to choose areas of the market that are showing favorable, positive relative strength, that's showing us the best opportunity while trying to minimize risk. And so we're going to avoid the areas that are weak, and then we're going to really find the areas that show the greatest opportunity so we can begin to take advantage of those opportunities for our clients. We think there'll be tremendous opportunity when we do that. We just need a little more time, and we just need to get those indicators to reinforce that time is there. So, we'll use our math and rules-based process to drive those decisions for us. And in the end, we think that we will be able to have favorable outcomes for our clients by doing so. And so this is my contact information. I'd love to hear your feedback on the things that we're doing, that we're talking about. If you have questions for next week or topics that you would like us to cover, I'd love for you to reach out to me. And this is my email, my phone number. And again, we'll be doing this weekly on Wednesdays. So I thank you so much for joining us. I hope that you are well, and we'll see you next week. Thank you.